What I will go with you through with you today is the incentive itself, the mechanics of the incentive. I will show you how you can use this incentive to gain a more competitive position on the talent market. So first of all, if you want to read it for yourself, the relevant legislation where this incentive for repatriates and inbound immigrants is located, where it can be found, is within the Personal Income Tax Law, Article 15V. And because the main element of the fiscal burden when it comes to employment income is mandatory Social Security contributions, we have a corresponding provision within the mandatory Social Security contributions law, and that is the provision of Article 15A. And in addition to these legal provisions which govern this rule book, a bylaw which details essentially the mechanics, administrative mechanics of the incentive. Now let's see what is the legal provision which we are going to deal with. The legal provision itself stipulates that the tax salary basis for a newly settled taxpayer for the salary he or she generates on the basis of an employment relationship for an indefinite with a qualified employer, wherein he/she has been employed on a position which requires specific professional education and for which there is a need which cannot be easily met on the local labor market, is the basis for salary tax lowered by 70%. Now, let's go into this legal provision in detail and dissect it. First of all, what is the logic behind the incentive? Well, the logic behind the incentive is that in numerous businesses in Serbia, business segments, have difficulty in finding qualified personnel. And this is something which is notably slowing and creating an obstacle to the development of businesses in Serbia. So the idea basically is to find to introduce a tax measure which would assist businesses in getting a competitive edge when attracting talent. This measure is also follows the goal of improving the Serbian demographic situation. Special rules are provided for those younger than 40 who are studying abroad. And what you will see is that the primary focus of the measure is on repatriating Serbian expatriates, so Serbian domestic citizens. But also the rules are provided equally or almost equally for qualified foreigners. So attracting foreign workforce is also covered by this provision. Now, let me give you some information on where does this incentive come from. What were the experiences of other countries that were under which this provision has been modeled. So first of all, this provision is basically it looks to the Dutch, the Netherlands solution, the so-called 30% ruling system, which the Dutch have introduced for some time now. And one may ask, well, what is the relationship between Serbia and the Netherlands? Why would anybody look towards the Netherlands, which is a very wealthy, a very developed country, when it comes to attracting talent? Well, the reasoning why this was done is the fact that the Dutch, the Netherlands, is actually in a very unenviable position when it comes to attracting talent. Why? Well, because the Netherlands is a relatively small market in comparison to its three closest neighbors. So up is London with its attracting power. Then you have the French market and Paris. And on the other side, you have the Europe's largest economy, Germany, all of which have far more potential attracting power for talent than, for example, the Netherlands. So the Dutch had to come up with something which would give them an edge in comparison to these markets. So essentially, we are doing the same thing. We know we are not the most attractive place to settle on the planet, so we are trying to provide something which would give us an edge. In addition to this, and something which proves us right, is that certain other countries which suffer from similar issues as Serbia does have introduced similar provisions. So, for example, at the same time, simultaneously with Serbia, it was Portugal who introduced similar measures in its legislation. And for example, it's interesting to note that 45% of Luxembourg's population is actually Portuguese, or their native tongue is Portuguese. So Portugal also has a huge immigration problem, a brain drain problem, if you will. Plus, Italy was a country which introduced similar measures in its legislation. More recently, 1 year after Serbia did this, it was the Greeks who tried to follow this model as well. So there have been notable comparative solutions that were followed when drafting these provisions. What do the provisions, what is the goal, what is the idea behind the provision? Now, I'm going to go with you through certain examples to show you what is the competitive edge which is provided. Imagine that you offer in current circumstances, so in circumstances where there is no incentive, not in current, but in previous circumstances where there has been no incentive in the past. Let's assume that you offer to your employee a gross wage of 235,000 dinars. Now, this is what we call gross one. The net salary which you would be able to provide to your employee under this gross salary would be 166,000. So by virtue of withholding the salary tax and mandatory social security contributions from the gross wage of the employee, he or she would be left with a net of 166,000 in case a gross salary of 235,000 was contracted. The total cost for the employer, because a part of the mandatory social security contributions are paid at the cost of the employer, so they are not withheld from the gross salary but are paid at the expense of the employer. The total cost of what we call gross two would amount to 275,000. So providing your employee with a salary of 166,000 dinars would cost you as the employer 275,000. Now, with the incentive, the situation is different. Assume that you have contracted with the employer 235,000. However, because the incentive tells you to lower the basis by 70%, the basis on which you will calculate salary tax and mandatory social security contributions is as if you contracted not a gross salary of 235,000, but a salary of 70,500, 30% of what you actually contracted. So due to this fact, the net salary which the employee will generate is 207,000, an amount which in the absence of the incentive would be obtained provided a gross of 293,000 was contracted, which would lead to a total cost to the employer of 343,000. While under the incentive at a net of 207,000, the cost to the employer drops from 275,000 to 252,000. So what you see is that basically you are capable of providing your employee with a net salary of 210,000 at a total cost, which would have been due for a net salary without the incentive of a roughly 150,000. So essentially, at a significantly lower cost to the employer, you are capable of providing a more beneficial net salary, thus being a far more attractive employer. Now, let's run through some examples to see the quantity of the savings which can be made. So let's assume that you offer your employee a gross salary of 2,000 euros. Now, if you offered your employee a salary of 2,000 euros gross, the net salary of this employee would amount to 1,418 euros, while the total cost that you would bear as the employer would be 2,333 euros. With the incentive, at the same gross amount, of 2,000 euros, the net salary of the employee rises to 1,826 euros, while the total cost of the employer drops to 2,100. So at the minimum level of 2,000 euros, your savings amount to 641 euros per month. So a very significant saving. If you provide your employee with a gross salary of 3,000 euros, then in this situation, the net salary of this employee would be 2,119 euros. And the total cost which you would bear for this salary would be 3,500 euros. With the incentive at the same gross of 3,000, the net salary of the employee rises to 2,736 euros, while your total cost drops to 50. Our monthly savings on this example is close to 1,000 euros, so close to 12,000 euros per annum. For a salary of 6,000 euros, the situation is that without the incentive, the net amount received by the employee would be 4,730 euros, and your total cost would be 75 euros, while with the incentive, the net of the employee rises to 5,619 euros, while the total cost to the employer drops to 6,172 euros, a total saving of close to 1,300 euros per month. So if you look at the numbers that we have here, what you will see is that the fiscal burden on these on these salaries is lowered to a level which is very, very beneficial for both the employer and the employee. While this is quite beneficial, the one negative that we currently have in our system is the fact that one of the two, and I'll show you the second one later on, is that this tax incentive does not apply for the purposes of the complementary annual personal income tax. So when calculating the basis for the complementary personal annual income tax, what you will take into account is not the taxable salary, not the basis for which you calculated salary tax under the incentive, but the full amount of the salary which you generated. So no savings can be made at the level of the complementary annual personal income tax. Why do I say this is a negative? Well, still the tax burden is extremely beneficial, but under the initial proposal, which was developed, the incentive was granted at the level of the annual personal income tax as well. So there is some space for improving this incentive further. Okay, now on this slide, you actually have a more detailed calculation of the potential savings, for example, 3, where you have the full calculation elements, including the exempt amount of the salary under general rules, and not the combined basis, not the combined burden for mandatory social security contributions, but the burden insurance, health insurance, and unemployment coverage. Now, what are the conditions that need to be met? Well, we all know you need to be a newly settled taxpayer, and we will see later on what is a newly settled taxpayer. We know that you need to conclude an employment contract for an indefinite qualified employer, and we will see later on who is a qualified employer. But the law, if you remember, states that the position for which the employee has been employed requires specific professional education for which there is a need which cannot be easily met on the local labor market. Now, There are two potential approaches to dealing with this condition. One would be that we would go through a complex administrative procedure wherein some authority in Serbia would actually check whether a specific employee meets this condition, and if there really is a need which cannot be easily met on the local market. And you probably all already feel that such a procedure would be burdensome, would be costly, and would contain some level of uncertainty. And therein, when we drafted this provision, we looked at the most practical approaches, and we looked at what the Dutch did, and the Dutch are a very practical people. And in the Netherlands, the approach they took is that instead of checking in every specific case whether this condition has been met, if you have been offered a gross salary above a certain amount, this amount testifies that you actually have skills which are needed on the local market, and you are a valid. Thus, you should enjoy the privileges of the incentive. And we followed the same example. So, in order for you to benefit as from the incentive, the newly settled taxpayer one salary, so the salary, the gross salary contracted in his or her employment contract of at least 243,450 dinars on the basis of an employment contract for an indefinite period of time. Individuals younger than 40 who have been studying abroad and are coming back to the country pursuant to the completion of their studies, the minimum gross that they need to make is, and it stands at a little bit above 160,000 per month gross. So if you offer your employee a salary which is equal or above this threshold, then the condition, the last one on this slide, has been met. You don't need to check further. You don't need to check with anybody whether this employee meets the required conditions. The salary, the amount of this offered salary itself testifies to this fact. Excuse me. Thus, the administrative burden for applying this incentive has been lowered significantly. True, you could attempt to apply the incentive in situations where the salary is below this threshold, but then you need to go into very burdensome and complex administrative procedures, and it is questionable whether or not this would be something advisable to do. Now, I told you that the incentive has two negative aspects, and this is the second one. For the enjoyment of the privilege at the level of the mandatory Social Security contributions, the conditions are equal, thus equal to the ones provided for the salary tax incentive. But beware of your future pension, namely, for the purposes of calculating your retirement age pension, once you fulfill your conditions for retirement, what will be used for the calculation of your future pension is not your contracted salary, but the basis on which you have been paying the mandatory Social Security contributions. So, due to the fact that this incentive lasts for 5 years from the day of the conclusion of the employment contract, plus it follows the newly settled taxpayer regardless of the change of the employer, and I will explain this in detail later. For the duration of the incentive, so in this case, for a period of 5 years, you would be able to benefit from paying a lower amount of salary tax and mandatory Social Security contributions, thus generating a much higher net income at a lower cost to your employer, but your future pension will be lower than the pension you would have generated if you didn't didn't enjoy the benefits of this incentive. However, if you go back and remember that in the case, and I will go back with you, just to show you, if you go back to a minimum salary which meets the condition for the incentive, which is roughly a salary of around 2,000 euros, you see that the net of the employee due to the incentive rises by more than 400 euros per month. Thus, this negative aspect related to the amount of the future pension is mitigated by the amount of the saving, but it is of course our duty to tell you all the aspects of the incentive, both positive and negative. And this is in addition to not applying to the annual personal income tax. This is the second negative aspect of the incentive. Now, this is something which is probably of the highest interest to a foreign audience, to an audience which comes from predominantly multinationals, and that is which employers can benefit from this incentive. Now, we know that we need to offer our employee a high enough salary to meet the conditions for. Later on, see who qualifies for this incentive, who can be deemed as a newly settled employee. We know that we need to offer to the employee an employment contract for an indefinite period of time. But we also know that we need to be what is called a qualified employer. Now, a qualified employer under the law is an entity who is a resident of Serbia for tax purposes, which cannot be considered as a related party to the newly settled employee's previous employer. Now, why these two cumulative conditions, and in particular, why the second one? We know that in Serbia at this moment, we have roughly around 11,000 individuals on secondment within multinationals which have their presence in Serbia. So employees of multinational corporations which are moving within the same multinational, within the entities which belong to the same multinational corporation in different countries. So somebody would have worked in, for example, France, and then this person moves to Serbia to work within the same multinational entity for its related party here in Serbia. Now, this movement within multinationals is something which has been going on for decades, and something for which no incentive is needed. Thus, due to the fact that we all need to be very frugal in these difficult times, no incentive has been provided for the movements within multinationals. In other words, your secondments will not be able to benefit from this incentive. However, so what you need is attracting fresh talent from outside of the organization. However, what then kicks in is the fact that this incentive has a demographic component. So what we want is not only to attract talent, but we want talent which will stay in Serbia. So due to the fact that we wanted to attract talent which will stay in Serbia, a provision, an exemption from this second condition has been provided. So a qualified employer is any employer who is a Serbian tax resident, provided that the newly settled employee has been a Serbian tax resident for at least 3 years counting from 1990. In other words, what the idea was that Serbian citizens, repatriates, people who are coming back from abroad, are more likely to stay here in Serbia once the incentive has been used, once the period of 5 years for which the incentive has been granted expires. So even within multinationals, if these secondments are made, what we wanted was to incite the multinational to, if they want to second somebody to Serbia, to choose Serbian citizens or those who were Serbian citizens. Now, since due to certain international obligations, we cannot discriminate on the basis of citizenship, we are prohibited from what you would call direct, explicit discrimination on the basis of citizenship. We did something which we are allowed to do, and that is we went for the so-called covert discrimination. This would not be okay if we were, for example, a member of the EU, but we are not a member of the EU, so until we become one, we can do this. Essentially, we have introduced a measure which does not invoke explicitly citizenship for the basis of obtaining the benefit, but if you look at the condition, which is at least being a Serbian tax resident for a period of at least 3 years, going back to 1990, those who will be able to fulfill this condition would be, in more than 95% of the cases, would be Serbian citizens. So if you belong to a multinational corporation, if you are looking at the potential benefits from this incentive from the perspective of a multinational corporation, you can use talent which has not been associated with your organization in the past, or you can also use it to bring in people from abroad which are already employed by your affiliates, provided that they fulfill this condition of being a Serbian tax resident for a period of at least 3 years, counting back from 1990. If they meet the conditions of being a Serbian tax resident for at least 3 years within this period, the period which begins with 1990, fulfilled to be a qualified employer is to be a Serbian tax resident, which, for example, any legal entity established in Serbia is. Now, let's go to the final issue, and the final issue is, who is a newly settled taxpayer? So who are the people, who are the employees? We know that these people need to be offered a specific amount of salary, that they need to be employed. So we need to conclude an employment contract for an indefinite period of time. We need to meet the conditions to be deemed as a qualified employer, but the incentive is offered only to newly settled taxpayers. Now, a new person which in a period of 24 months preceding the conclusion of the employment contract with a qualified employer has not been predominantly present in Serbia. So what we look at is a period of 2 years prior to the conclusion of the employment contract, and we looked at whether or not this individual has been predominantly outside of Serbia during this period. So if a person would come to Serbia for, let's say, a vacation or to visit their family, this would not impede this condition, and they would still be deemed as not being predominantly present in Serbia, provided that they are, for example, fully employed and are living in a different country and primarily stay there. Now, for those who are younger than 40 and who have been outside of Serbia for the purposes of further education or gaining additional qualifications, the period within which they need to meet this condition that they have not been is lower to 12 months. So, for example, if you want to target a master student, and many master courses last now for a period of 12 months, for a year, such a person would be eligible for this incentive, even though it stayed abroad only for the duration of the course of the master's course, which lasts for 1 year. Now, in addition to not being present in the country for a period of for a period of at least 24 months or a period of 12 months for those younger than 30 who are staying abroad for education, the newly settled taxpayer needs to meet certain conditions with respect to the quality of his or her settlement. Essentially, this person needs to meet two conditions, which are stipulated as being a Serbian tax resident on the basis of having their center of vital interest in Serbia, as well as being a Serbian tax resident for the purposes of all Serbian double tax treaties. Essentially, this would mean that, but in effect, this is one and the same condition. In effect, this person needs to permanently settle in Serbia. So what that means is that there needs to be a permanent residence in Serbia, a place of living permanently available to this person, whether rented or owned. This person would need also to, if they have a family, their family must move with them. Because in order for your center of vital interest to be in this country, your family needs to be with you in your center of vital interest. So in order to qualify for this incentive, what you need to be doing is you need to be permanently settling in Serbia for at least a notable period of time. And all the aspects of your private conditions need to show this, need to evidence this fact. So now the question here arises is that, for example, especially if you're not a Serbian citizen and you have no previous connections to Serbia, when do you need to meet this condition of permanent settlement? Because we all know that moving to a country is a complex process. So what you need to when does permanent settlement needs to occur is simultaneously with the conclusion of the employment contract or within a reasonable period of time from the conclusion of the employment contract, wherein the bylaws define this reasonable period of time to be no longer than 6 months. So what you have is a period of 6 months from contract to meet all of these aforementioned conditions for your permanent settlement to be completed. Which needs to be met. Now, two conditions, two aspects of this incentive which should be looked at. First of all, this incentive is drafted in a way, has been tailored in a way to follow the employee. What does that mean? That means that, for example, let us assume that I have been abroad for a notable period of time, and now I am returning to the country. I am getting an employment contract for an indefinite period of time with a qualified employer A. But after, and remember, the incentive lasts for 5 years. And then after 2 years, I am offered a better employment package, remuneration package from employer B, who is also a qualified employer. And I quit my job with employer A and I conclude the employment contract with employer B. I can still benefit, as well as my employer B, from the incentive for the period of the remainder of the incentive, which is, in this example, 3 years. So that's what's meant by the incentive follows the employee. Changing your employer does not mean that you forfeit the benefit of the incentive, but actually, provided that all the conditions are met, you continue to use it within the time frame of 5 years. That's number one. Number two is that the bylaws have envisaged a procedure for documenting the fulfillment of the conditions for the use of the incentive to be, well, as easy as possible. So, in addition to the fact that, for example, with respect to the position that you're hiring the person, the newly settled employee, that you are proving that the conditions are met by offering a high enough salary, right, without any other administrative burdens. You don't need to submit any requests or any documentation to the Serbian tax administration actually requesting this documentation. So what you need to do, what you file, what you must have on file is documentation which proves that the conditions for the use. But this documentation is to be provided to the Serbian tax administration on request. So you don't need to get any prior approval nor to provide documentation unless you've been asked for it, while you start applying the incentive from the first salary that's been paid to the employee, provided that the conditions have been met, or that they will be met in case of permanent settlement within this reasonable period of time, which is 6 months, and then you have to evidence that this has been done once the period expires. The documentation which needs to be collected is actually has been envisaged in a way to actually encompass the realities of Serbian life. So, for example, under Serbian, this is something which could resonate with those coming, for example, from Italy. So, for example, in Italy, in order for you to stop being a tax resident of Italy, you need to deregister officially from the Italian tax administration. They will deem you a tax resident as long as you have not deregistered. Now, in Serbia, we also, for example, for the purposes of general residents, we have similar rules under which an immigrant should actually report that he or she is leaving the country to the authorities, so that they can, be able to know this. And also they should, of course, report their new address, for example, for contact if necessary. But very few people actually do this. So if we were to ask for, a confirmation that you have deregistered yourself to show that you have actually not been present here in Serbia for a significant amount of time, then this would limit the application of the incentive to only those few individuals which actually followed the formal rules in Serbia. But since they are a minority, the bylaws will provide you with alternatives. So, for example, providing your employment contract with a foreign employee, or your excerpt which shows that you've been subject to mandatory social security insurance in another country, would be sufficient evidence that you have been abroad for a period for the required period of 24 months.